You know that moment during the holidays when everything just feels right. The tree's lit, the coffee's hot, and that first bite of sugar cake just melts in your mouth. Yep, that's Dewey's Bakery. Here in Winston-Salem, Dewey's has been baking up holiday magic since 1930. From their classic Moravian cookies to cheese straws, and of course, the holiday cake squares, where you can still get one free every Monday. Right now, it's the season for sweet treats at any of our 3 Triad area locations. In Winston-Salem at Thruway and Renolda Manor, plus one in Greensboro at Friendly Shopping Center. Easy holiday ordering is also available at local.deweys.com. It's also the season for raising sweet dough for your organization. Just contact any Dewey's store for more information on how you can set up your own holiday fundraiser, where 50% of the items sold go immediately back to your organization. Plus, holiday stores are popping up from mid-November all the way until Christmas Eve. In the Triad and beyond, these special holiday shops will assist in raising money for nonprofits, and the locations can be found by visiting deweys.com. So make the holiday special for the ones you love and others with Dewey's Bakery, home of free Cake Square Monday all year round. Dewey's, celebrate every day.
This is the Triad Podcast Network.
Hi, everyone. Thank you for joining us for another financial episode with our certified financial planner, Jennifer Johnson. We're here in person in her office in Winston-Salem. They are right across from Thruway Center, right across the street. And their office is 3 Magnolias Financial Advisors. They're local here to Winston-Salem. We talk all things money with her, and sometimes, like today, some very special guests to offer some expertise on various topics. Jennifer, this time of year, we typically talk about year-end goals, or we've talked about, things that you should remember to do before the year is over as it relates to your 401k, to certain tax benefits, making sure that you're taking care of those things. And we have episodes from that. You can go back and find our December 2024 show and be able to find some of those topics. So because we've covered that again, we don't want to go over some terrain that's already been covered. We want to get into something different today. And so with that, I will turn it over to you to introduce what our conversation is going to revolve around.
Yeah, I guess nothing says the holidays like health insurance, right? So I know that we may hear some buttons turning us off right now. I hope not, because we have a really good episode, I think, in store for you. I asked my friend Paul Spanos to join us. He specializes in health insurance with his company, Community Employee Benefits. And he's local here too. He's been a great resource for my folks because I have certainly found health insurance to be a little bit more complicated in the last few years. You might disagree with me. Paul, do you agree with that statement?
No, I agree with you. It's a mess.
It's been a mess, yeah. So we've worked together for a few years because most folks that have heard me before, if you know me, we don't specialize in health insurance. It's an important piece, I think, of people's financial security and making sure you do have a safety net that allows you to work towards some larger goals, I think. But I personally don't think it's fun at all, actually, which I think is why Paul's here to take care of those things, because it is a big issue. Particularly for people that either don't have health insurance through their job, so that would be relevant for you, or a lot of times I'll bring Paul in where I have someone who wants to retire before Medicare age, which is 65, and solving for that issue of what are we going to do for health coverage for them. But I tried to think about when I met you first. Do you remember when I met you first? Because I can't come up with a specific
It's been
day.
a number of years ago. I would
say
5 or 10 years ago.
At least. We had, I guess, some colleagues that knew you well, and Paul would always call our office and pretend to be the IRS. So I always remember. You doing that, and we had.
I'd love to recreate that.
I know we had, caller ID. So I knew it was you. It really didn't scare me that bad. I don't know if you scared anybody else.
Not everybody has caller ID, or at least they didn't pretend that. At that point.
Then it was so old. Like there was maybe some people without caller ID, but we've known each other a long time. But we probably got to know each other better when we both were on the FSP chapter, the Financial Service Professionals, which is like a trade group for those of that you don't know, probably don't know that group. But it would bring together different financial service professionals. So you'd have like your bankers, you'd have your insurance folks, certainly have investment advisors and financial planners, attorneys, CPAs. Which your background, you're actually trained as a CPA. Is that fair to say?
I completed the CPA exam. I can't use that title because I never practiced in it.
Yeah,
so I call myself a recovering accountant.
We can edit that out. Yeah, like that's. But you do have an interesting background and have been a great resource for my folks. Because I think it is a big issue. I mean, I can see how it happens in talking to people, and because we know those out-of-pocket costs, even if you have pretty decent insurance, people start to have a lot of serious health issues. I think it seems like particularly around, surgeries or prescription drugs, if somebody has cancer or something, even when they have coverage, it still can be a big financial burden. I mean, and even in some cases leading to bankruptcy. I don't know if y'all have heard of those stories.
That sounds a little scary. So I'd love to hear about. I mean, I think people just kind of take it for granted if they are employed and they have health insurance, and just how big of a hit that could be if you don't have it figured out.
Well, that's right. I mean, Paul can speak to it better than me, but a lot of the policies do have fairly high out-of-pocket costs, even if you have coverage.
Correct. Most of them these days are between $8,000 and $10,000 maximums per person.
Yeah.
So if you, depending on what kind of plan you have and your income, and if you can structure your income, which you come in handy on that side of it, if somebody's getting ready to retire and they know they need 2 or 3 years to get to 65,
right?
If they can structure their income during those 2 or 3 years in a way that they use non-qualified investments instead of necessarily pulling out of 401ks or qualified money, they can get a pretty decent plan at a reasonable out-of-pocket limit. Mm-hmm. Probably this year's been a little bit challenging just because of the law changes.
Yeah.
The sunset provisions on the 2021 law. A lot of the subsidies are going away for next year. So not all of them.
And that's specifically like to the Affordable Care Plans, is that right?
That's correct.
Which Medicare, we don't want to muddy these waters too much, but Medicare somewhat is income-based too. Right,
yeah,
with
the
some
IRMA
of
tax.
The premiums, but we can save that for maybe another day. But I think that it is a big challenge, because it sounds like you have some opportunities to maybe control premiums a little bit depending upon your income, but the out of pockets are still fairly high. Is that right?
So let me back up for just a second, if I could, and maybe try to address who we're trying to reach in this conversation. Are we talking to people that have employer-sponsored health insurance plans, or are we talking more toward people that have to go out and find their own health coverage, regardless of what their employee status might be?
I think the focus are people that need to buy their own.
Okay.
That's generally because if you have it through work, you're generally, have a contact at work and you have 2 or 3 options typically. Now, I will say, related to the financial burden, I think that still applies. We see, data out there. I looked at a little bit of updated data, which you hear this consistently, that a lot of bankruptcies are a result of medical debt, and in those cases, some of them have insurance, and a lot of them, I would guess, are through their jobs. I think I found 66.5% of personal bankruptcies in the U.S. are tied to medical expenses. People, with medical debt, a lot of them owe $10,000 or more, and a lot of those folks do have coverage. I think that maybe relates to this idea of being prepared for out-of-pocket expenses, which I do think would apply to everyone. But, largely who we're talking to today are folks that either your job doesn't offer it. So I would say to you, it's really important that you have it. Years ago, for example, I met with a lady for the first time just before this meeting, and a lot of times I would almost take for granted that she has health insurance. Well, this time I don't. I say, okay, now you have health insurance, right? Does your job offer health insurance? Because I find a lot of younger people in particular, though certainly some older people, can sometimes leave that hole, there, and it can be really devastating. But I mean, the good news is somebody like Paul, I think, can really be a good resource for people that
Yeah.
don't have it. So I don't know if it's helpful to maybe do the basics on those affordable care plans,
Sure.
Paul, because those are, am I right? That's where you would go primarily if you don't have it at work.
Correct. If it's not available at
And
work,
you're not Medicare age.
I would say 80% of our customers have something through the healthcare.gov or the
Okay.
Affordable Care Act. I mean,
Okay.
and they're getting a subsidy of some sort. Because
Okay.
those subsidies are still out there for next year.
You might have to
But they've
explain like
adjusted.
what's a subsidy for people that may not know.
What a subsidy is if you're single and you make between $22,000 and $62,000,
Okay.
then you're going to be eligible for a subsidy. If you're
Okay.
married, kids, those numbers start going up depending on how many
Okay.
people are in the taxable household. But what's changed is there were folks for the last 4 years that have gotten a subsidy that were, I would consider, higher income.
Okay.
That's going away. So that's
Okay.
where a lot of the planning comes in. And in our situation, unfortunately, we're on the front lines right now because when they get that renewal in and it goes from $600 to $2,000
Wow.
a month,
Right.
because they're losing a subsidy. If they're
Right.
a household of two that's getting ready for retirement, but they're making over $85,000 roughly, they're not going to get a subsidy next year where they had one for the last 4
Okay.
years
So is that kind of the cutoff, about 85,000 if you're
for a household of two.
for a household?
Yeah, it keeps
there?
going up as you have more dependents.
Okay.
Got a few
Okay.
few people that have 4 kids, there might be 170,000 is the cutoff.
Okay. Oh,
But
okay. I see.
it varies based on how many people are in the taxable household.
And that's the household income. So
Mm-hmm.
if you're dependent upon where your household income is, that's going to affect what you would pay for these affordable care plans. Is
That's
that right?
correct. And a lot of those folks, we don't do anything on the investment side, but I always explain to them you have 3 ways to get that income down. If you're right on the edge of one of those numbers, certainly putting money into a qualified plan helps you.
Okay. Yeah.
Money into an HSA if your
Okay,
plan's eligible
right.
for that. And then if you're self-employed, your premiums are deductible. So those are 3 things I always bring up
Okay.
that will help you get. These are above the line deductions that get you down
Okay.
to, because they use adjusted gross income for the
So you
most
can
part.
see where the CPA piece of this is coming in, people, right? Like, because
Yes.
your income matters, which I think a lot of people don't understand. And I think this was part of the fight where the government was shut down, right? Is like this was part of the sticking point was, how much to give in subsidies, and that unfortunately, like the timing on that was terrible for y'all, right? Because it wasn't.
Correct.
It's sort of an open enrollment period for 2026. That's
Yeah, the open enrollment ended Monday, but there's one more deadline on the 15th of January.
Okay.
And then they have the option to do some changes between now and the 15th of January, and then it sort of shuts down. The
Okay.
exception to that is if somebody leaves a job, they have 60
okay.
days.
If you have a change.
Yeah, if you have a change
Okay.
where you're losing coverage, you have 60 days.
So you can see why this is our holiday topic of choice. There are some deadlines here. I tried to get Paul on before, but he was helping so many people that this was his first available date. So, well, we're grateful that you did that because it is, I think, really, really important. So, so if if you're in that situation where you're like, wow, I really do need to have health coverage, I don't have it at work. I would say irregardless of your age, like you still have a chance, it sounds like, to sign up. I think you said the coverage would kick in February in that
Correct.
case
Yeah,
if you
the
met
last
the next deadline.
if they do something by the 15th of January, then it's effective February 1st.
Okay. Let me ask this too, because you asked who's this for. Like, let's say you have coverage at work, but it stinks. Like, can you still qualify for these plans? Because I'm never quite sure
Generally
about
not.
that.
Generally
Okay.
not, because as long as the plan at work meets a minimum standard,
Okay.
then
that standard's
even though
pretty
it's an awful
low.
plan,
Yeah.
it could be an awful plan, and if it costs you less than 9.96% of what you earnings
Okay.
are at that job,
Okay.
you don't get a subsidy.
Okay.
Now, there's the exception. If you're a smaller business, less than 50 employees, and it costs you more than that roughly 10% of what you're
Okay.
making, then you have the option to go on their group plan or to go out and get a
Okay.
subsidy. If it costs you more than 10%,
What makes a plan an awful plan?
Yeah. I use the
if
layman's
it's all deductible and real high copays, and it doesn't cover your prescriptions that great. And there are some out there that, on the individual and the group side, that are
Sure.
pretty awful. They're going to have the catastrophic cover. They're going to all have, the group plan's going to have a $10,000 out of pocket limit.
Okay.
But I've had plenty of people that, they go to work somewhere and they go, my plan's awful. I say, well, if you're full time, working 30 hours a week or more, I can't, now if they drop to part-time or if
Okay.
they meet the unaffordability test and it costs them more than 10%. But most employers keep it under 10% because if they're a
Yeah.
larger employer, they get penalized. If it's not,
Right. Okay.
if it's above the 10%, the employer gets dinged.
Okay.
So most of the larger companies are going to make it affordable.
Okay. So assuming it's not a health issue that would prevent you from being able to get on these things, right? Because I remember years ago, before these plans were out there, I might have a 60-year-old that wants to retire, but if they have some pretty serious health issues, you'd really be in a pickle. Like you just, because 65 is the Medicare age. So anytime you go to retire before that, and a lot of people cannot stay on their group plan after they retire. I think that's a common misconception too. Like you can't, in most cases,
You'll get the
can't stay
18
on.
months COBRA or state continuation, but after that,
I don't know many, if any, that would allow maybe state jobs, I guess. Would be
if you're
something
vested,
like that.
then you could probably stay on board
Right.
Under that side of it. But generally, you have 18 months of state continuation or COBRA, and then after that, you're on. And a lot of times, depending on income, they could certainly take COBRA, but if they can control that income in that 2 or 3 year window, then they can come out better on the outside. This year, unfortunately, rates have gone up and subsidies have leveled
gone
off a little
down.
bit.
So they did come to an agreement when they reopened the government, but subsidies are lower.
Subsidies are
Meaning
lower.
you're paying more for that coverage
That's correct.
than you did last year, no matter what. But you can't be turned down, it sounds like.
Correct. It's all guaranteed issue. The only thing I always warn people, and it usually hits the person that's just above the income threshold.
Right.
When they get that renewal and it's pretty ugly, then the person says, well, I'm going to look around. I'm like, well, that's fine, but understand everything through healthcare.gov, and there's similar plans outside of healthcare.gov that are guaranteed issue with no pre-existings. But there's also a lot of pretenders out there, is what I like to call them, that are limited medical plans, and if they start asking you health questions, then it's a pretender. It's not a full-strength plan.
Okay.
So that's why I always tell people, be careful, and there's some common names that people say, hey, I got it cheaper over here. I say, well, it's cheaper, but it's not the same coverage. It may not have a 10,000 maximum. It may have no maximum. So you may end up...
could potentially is unlimited liability, which is where you end up with people with more than 10 grand and medical debt and potential bankruptcy. So I guess that's a really good lead into like when you're evaluating these plans. What do you think are the key things for people to be looking at?
Well,
besides just the premium, right? Because you can't just look at the
part
premium.
of it. And if it's I have someone that says, hey, let's say my premium is $500 and they find one for $200. It's not that I don't know the market, and I know what's out there. The problem is the ones that are real inexpensive that ask you health questions, you don't really know what you have until you have a large claim.
Right.
So that's the part that we get
Right.
frustrated with. The person says, well, hey, it looks the same to me.
Oh, really? Okay.
And bottom line is the person selling it is not, when you get your contract, it's going to say limited medical plan all over it. So we just have to be careful.
So if you see the word limited,
yes.
That's
where you want to step back a little bit. And usually when the person gets the contract, they've already paid the first month's premium, and then they go, wait a minute. And I've had some people that have done that this year. We probably have 10% of our clients have come off healthcare.gov.
Okay.
Because either they're going on a group plan through a spouse, or they took a different job, or some unfortunately are going uncovered. There's a bunch that have said they're going to go uncovered. They're not going to pay that. If they're not getting the subsidy anymore, a lot have decided not to pay it.
Right. Scary. Yeah, for all the reasons we just said. If you go on healthcare.gov, are there multiple providers or multiple insurance carriers on there that you choose from, or is it? Yeah.
It depends on the county. It's the strangest system because
set up?
County by county, if you're in the far eastern or western part of the state, you may have 2 carriers to pick from. I can promise you there's 1 carrier in every county, but the lowest I've seen is 2. I quoted somebody at the coast the other day, and I pulled it up, and there was 2 carriers.
2 choices.
To pick from, and that was it.
Okay.
But there's multiple. The biggest challenge on healthcare.gov policies is most of them are limited network plans, meaning that when they may recognize an insurance company and say, oh, I've had that company before at work.
Right.
Well, but the one you had at work has a full network where you go see both hospitals in town.
Yeah.
The one you buy through that system may be a limited network that only covers 1 hospital in town.
Okay. And what does that mean? Like you just can't go to that other one, or is your
not in
out
network?
of pocket?
If you have an emergency and you go to the other hospital, you're fine. But if you're seeing Hospital A and your plan only participates with Hospital B, and their particular providers, if you go see Hospital A's providers, you're out of network. So they're really not going to pay anything towards it.
So they just literally pay nothing, like unless it's an emergency thing?
Correct.
Okay, wow. So that's important to know, right? Depending on where you're getting your typical care, right? Because does that filter down to doctors? Because, I mean, we all know here there's basically two networks that you're going to see most of your, even your regular doctor, your family doctor. So if, like I think I've got both of them represented probably in different, care providers. You wouldn't think I have a lot of issues. I guess I do. Does everybody like that? Does everybody go to?
I'd say 75% are one hospital
one
system
or the other. Yeah.
There's occasionally somebody spreads the wealth and says, "I'm going to go to this one and that one. I go here for this."
For
and
my
there
toe
for that.
doctor, I go over there. And my ear doctor, I go somewhere else. Right? It's out of.
And
I guess you got to be aware of that, right?
And some of those prices have narrowed. I mean,
Okay.
there's some carriers give you the choice of having one hospital or the other, or both.
Okay.
But as you might imagine, the one that covers both hospitals is
More
not going to be the
expensive.
cheapest plan.
Yeah.
Exactly right. It's going to be the other extreme. It's going to be the most expensive option.
Well, yeah. And what about prescription drugs too? Is that like a totally different animal? Like,
It depends on the prescription, but all the carriers have different formularies that
Okay.
basically say, if you're taking drug A or drug B, if you're on a bronze level plan, which is typically the least expensive plan, it's
Okay.
not going to help you a whole lot on prescriptions. You're going to have to upgrade to a silver or a gold plan, which
Okay.
means paying more
paying more? Yeah.
and hoping that particular drug is on the formulary for that carrier,
Okay.
whichever carrier it happens to be. And most of the time, they'll have something covered in each therapeutic category, they like to say. So
Yeah. Okay. So you typically it's gonna be built in there. You're gonna have some level of prescription drug
correct.
coverage. Okay. Yeah.
There's no place like home for the holidays. A place where memories are made, a place where family and friends come together. But we know that it also brings a lot of stress. And what if you're also thinking of buying or selling a home during this time of year? That can add even more. In fact, a recent Zillow study reported that 85% of buyers said the experience of buying a home was somewhat stressful or even extremely stressful. Okay, take a breath and listen to the good news. The Ginther Group can help relieve some of that stress and pressure. Of the more than 130 people who reported 5-star reviews this year, over 100 of them described the experience of working with the Ginther Group as stress-free, smooth, and in some cases, fun. Don't you need a little bit of that in your life right now? If you're seeking the perfect home for your holidays, then call the Ginther Group now at 336-283-8689 or visit their website at theginthergroup.com. Even if it's not the right time to buy or sell, that's okay. You can still meet with them about your 2026 real estate goals so that you can work with a team you can trust to have you ready when the time is right. That's 336-283-8689. Call the Ginther Group today. If we can maybe talk about some of the financial distress that this could cause for people that have poor health plans or no health plans at all. Like, what are we talking about here in terms of what this can do to somebody from a financial standpoint? And then, and then we'll get into just things that they can do to try to either prevent that or recover from those.
Yeah. Well, I think I'll give you like kind of a real life example. Obviously, I won't use any names or anything like that, but I had a client retire. I don't remember if he was pre-Medicare age or around Medicare age, because he stayed on his spouse's coverage, which fortunately was really good coverage because I thought he was extremely healthy, and he started to have shortness of breath and all these issues shortly after he retired. Well, it turns out he had some sort of genetic condition, ends up having to have a heart replacement. And he said, Jennifer, do you want to guess how much a heart replacement costs? Do you, either one of you two, do we have to eliminate Paul here? Is this unfair? Like, we can see who's closest to the pin here if you want to guess what that.
All right. Well,
he's doing well
up,
too, by the way.
I'm going up against the expert.
Doing real well.
Heart replacement costs.
Successful heart transplant.
I got to think minimum $100,000.
Okay, you're way under.
And I have no idea. I've not seen that one. I've seen other hip replacements, knee replacements, but I haven't seen a heart.
Okay, yeah. You want?
You said I'm way under. Is it $500,000?
It's $1.5 million.
Oh my goodness.
1.5. Now, luckily, that wasn't his cost. He had luckily he was on a really nice, at the time, generous group plan. So, because that was part of my conversation with him. He's probably a year and a half into retirement. We've just settled into kind of a budget. We're taking withdrawals from, what was his 401k that we've pretty regularly, kind of got that normalized, right? And then I'm like, whoa, is this going to explode? Our retirement, because even as we've talked, some of the coverages have significant out of pockets, for the family. So he was very fortunate, and that's maybe an extreme example, there. But, if you go to the hospital for practically anything, it's a few $1,000s. And then if you have a surgery, and I think if you don't have coverage or you have, a high out-of-pocket costs or you're out of network or something like that, I think that financial burden's really high. I mean, that's, we mentioned before, even so much as bankruptcy, and a lot of times people, have coverage, frankly, but they aren't prepared, for those kind of out-of-pocket costs, and eventually they realize, well, maybe especially if you can't go back to work like you thought you were going to, and of course I think having disability coverage is outside probably the scope of what we'd want to cover today. But a lot of times, you're experiencing these high costs at a time in which you're also out of work, if that makes sense too. So your loss of income, high expenses, is just kind of a recipe for, for damage, from an immediate standpoint. And then also you could see how that person could then get behind, we talk a lot about other savings goals, how to, save for college or retirement. Well, if you're faced with 10 grand plus in medical debt, and then you've lost your income maybe for 6 months because you've had something significant, that, I think, does that make sense, Adam? I think it's really eye-opening if you start to look at that data and you realize, because part of us wants to think, well, that person that's bankrupt was lazy or something like that. A lot of times it's this issue, unfortunately, and I hope this can be helped with people being a little bit educated and having some resources to at least avoid the dire outcome.
Well, and I think it's on a claim like that, that's a huge one, and we don't see a ton of those.
Of course.
But we see a ton of $100,000 claims.
I bet so. Like, what's a hip replacement?
A hip replacement, after all the discounts, is probably $30,000.
Okay.
Is what I've seen. Knees about the same, 15 to 20 at the low end, but the biggest issue is the average person has no clue what's out there. I mean, when you're talking to them, if it's a younger person, they say, "Well, I don't want to pay $200 a month. I don't
go to the
use
doctor."
It. Right.
Yeah,
and that's what I hear
never
more
go
often
to the
than
doctor.
not.
Yeah.
I just tell them that person has no concept for what it actually costs. I mean,
Yeah.
I know I had a family member that had a broken foot a few years ago, probably been 5 years ago. $50,000 at the local hospital here, and it was outpatient.
Oh wow!
There's a bunch of procedures that are $50,000 to $75,000 that you don't even think about, and you see the person walking down the street the next day.
You're right.
So it's not like they're in a bed and they're disabled for months at a time.
That's right. That's right.
They had a $50,000 procedure and they're back at work in a week
I
or
know.
two.
And unfortunately, and this again, we could talk about this for a day too, but just the healthcare system. I mean, when you don't know, it's not like shopping for shoes, When you go in there, you don't know that cost, right? You're, at least in my experience, when they're talking about, you need a foot surgery.
Right.
Most of the time you don't know what that cost is. You don't know, you can't shop it. I don't know.
You don't know, and I'll hit on prescriptions a little bit. Prescriptions are pretty high these days. The average person that has maintenance drugs, not a big deal.
Right.
But I had a phone call this past week, younger person. Policy lapsed a month or two ago.
Oh, wow.
They called me up and said, "Hey, is my policy still in force?" I said, "No, it's not." And it's open enrollment. And the person said, "Well, I've got to go pick up a prescription."
Oh,
and
gosh.
it was about $1,000 for the prescription.
Yeah, right.
And they said, "I just thought about that." I was like, "Yeah." So they're basically right now they have no coverage. They could sign up for February 1st at this point.
Yeah.
But until somebody has something like that, they don't see it coming down the pipeline.
Yeah, so I wonder if were they kind of thinking I'm probably not going to get this prescription. I would guess they're probably like I'm going to wait until February. God knows what that was. I'm sure their doctor would not recommend that.
And there's a lot of manufacturers' coupons that'll help in that situation and things like that. But the bottom line is the average person has no clue that if somebody's on I think of Crohn's disease as one of those that has a lot of expenses with it, or a diabetic.
Yeah,
I see a lot of that.
Diabetes, is a big one, right?
If you're oral medication, it's not as bad. But again, depending on what that diagnosis is, that person doesn't have a choice. They have to have health insurance.
Well, that's right. Yeah, that's right. And those supplies are pretty expensive too, right? And they can't. You just can't avoid that. I mean, you could literally die, right? And so, sad to say, but I have read stories of people having to make choices about do I get my diabetic supplies or do I get food. I mean, it's just an awful thing to really think about. Now, is there kind of a silver lining with these policies in that if your income's pretty low, talk about that? Because, I mean, obviously some of my folks, we're trying to keep them under that threshold if we can as they move close to retirement sometimes if they're not quite there. But if a single person is in the 20-some thousand a year range, or a married couple in their 30-some thousand range, they get a great plan. Maybe a $1,500 to $3,000 out of pocket limit. Okay, better than most group plans are. Really,
but again, it's dictated by whatever that income number is.
Okay,
as that income, it's a sliding scale. So as that income goes up, the premiums go up, but the plan gets worse.
Okay.
So if I have
is that right? So, and that's one thing that's always been confusing to me because I'll have some people say, well, mine's only $50 or, some crazy low number. This is years ago. So don't quote me on those numbers today, people, and it's great coverage. And you're just like, well, how? I mean, because I would be working with folks that have saved a lot, and they're moving into a time they want to enjoy their retirement. So their income's up there and they would say, well, gosh, we're paying $1,400 a month and scared to death to go to the doctor because it's all going to be out of pocket costs, And
that's unfortunately, nobody wants to talk about income, but if there's two neighbors talking to each other and one of them's paying $100 a month, the other one's paying $1,000 a month, I can promise you the person paying $1,000 a month's income is higher.
Much higher. And their coverage is worse, if I heard you right.
That's exactly right.
Wow. Wow. See, that's confusing to me.
Yeah, it makes total sense, right? Jeez.
Yeah, we used to ask you how tall you are and how much you weigh. Now we just ask you how much money do you have. So we've changed questions.
Right, yeah.
Jeez.
Oh my gosh.
Wow.
Oh my gosh.
So one thing that we wanted to get into, and I'll ask each of you this question, is Jennifer, we talk a lot about retirement on this podcast, and everyone thinks I'd love to retire early. I want to retire in my late 50s or when I'm 60, and but maybe people don't think as much about what's my cost of living when I retire, and they don't factor in that. Okay, I'm not eligible for Medicare yet.
That's right.
So what kind of thoughts or advice do we have for people in those situations?
Yeah, it's a real common conversation I have with people. I mean, because you're right. I mean, the typical retirement age has been 65, but people are all over the place, and sometimes people want to retire sooner than that. And if they do, that's where I started really, unfortunately, kind of a hard conversation about, well, if you want to retire before that, we've got to figure out your health insurance coverage. Because especially in the last few years, more and more, even if you work for a large employer, they don't allow you to stay on that group plan, right? And so we'll talk about, okay, what's that gap, between if you want to retire at, say, 60 or even 62. 62 is a fairly common retirement age. I find that's the, unless you're a widow or a widower, that's your earliest age to collect Social Security. So that becomes a popular target, can I do it at 62? And one of the first conversations beyond what are your basic living expenses today is, what are we going to do for health insurance? Exciting, I know. It's not what people dream of, right? And then, what I have is resources. We have really some tools that can say, okay, here's what the average person or couple, if you're 62, might spend, on health care. And it tries to estimate, okay, for what would that premium be and what would those average out of pocket costs. That's where, for me, having somebody like Paul that I can say, well, go talk to Paul because, maybe you're a serious diabetic, and, we need to make sure we understand what your costs will be because it is income driven, right? And so, make sure we kind of work together because I think, there's two things going on. One is people don't understand Medicare. I think I would agree with. I mean, would you agree with that, Paul?
Correct.
Because y'all help people with Medicare supplements and stuff too, right? When they get to
when
that
they transition to that, we help them with that as well. Then income is less of an issue there.
Right.
Yeah, you have the IRMA tax issue if they're above a certain amount.
Yeah.
But I would say 80% of our customers are below that IRMA tax threshold, so they're
pretty standard.
They're not getting hit with a surcharge.
Yeah, I think that, and they just don't understand that when it kicks in. They don't understand that you may be eligible for Social Security at 62, but you're not eligible for Medicare. Yeah, and so that's something we have to talk about. And I think too, when you think about somebody sits down and says, "Well, we're only spending X dollars," you've got your take-home pay maybe, and they'll look at what their household is spending. A lot of times they're paying for that health premium before they get, their take-home pay, so it's not reflected, if that makes sense. Like if you sit down to add up your bills, you don't see a healthcare premium in there, and so I have to say, well, remember when you're no longer working there, we're going to have to add something on for healthcare, and because we've already talked about it. I mean, it's just too. It's too devastating, I think, to go without it, particularly as we get older, I think. I mean, that's my feeling. I think you would agree with that, probably, Paul.
I agree. You got to have. I mean, it's a risk, and if you don't cover that risk, you're going to. And unfortunately, a percentage of people are going to have those claims. I don't care if it's a broken foot or a knee surgery or whatever. I mean, they're going to have those claims, and again, a lot of them are $20,000, $30,000 or more, depending on what the procedure is.
Yeah.
So what are the options for people to bridge that gap between an early retirement and when they're eligible for Medicare?
Yeah, I mean, I think the Affordable Care Plans are probably the number one. Now, I think sometimes, people can do COBRA, and I don't know if it might be helpful to explain what COBRA is. Does everybody know what COBRA is? I don't know.
I do because I recently had to use it, but I do think it would be worth explaining.
Yeah. Do you explain it, Paul? You're going to do better than me.
And I'll put COBRA and state continuation in the same bucket.
Okay.
It just depends on the size of the employer. If they have more than 20 employees, then it's COBRA. If it's less than 20, then it's state continuation.
Okay, all right.
But other than that, they're very similar. And it typically is the same rate that your employer is paying, but it's unsubsidized now. So if while you're working, you may only be paying a couple $100s a month for it. When you leave, it might be $800 to $1,000 for a single.
And that's because your employer has been covering part of that cost that you just weren't aware of, right?
Yep. And typically, COBRA is a flat rate. Doesn't matter what your age is. So if I'm talking to a 25-year-old versus a 60-year-old, the 60-year-old is going to say, well, that rate's not too bad because they've already looked on the other side of the fence and seen what the regular rates are for them. And they go, I think. So we have a lot of folks that end up taking COBRA. After our initial consultation, COBRA's their best deal for a year.
Oh, really?
Yeah, a lot. It all depends on that income factor.
Sure,
I usually just tell them that first year, income's not relevant, so go ahead and take a bunch out because you might as well take COBRA while you can get it.
Yeah.
And then before that 18 months is up, then you can basically, if you can adjust your income later.
Yeah.
But COBRA is a better deal for a lot of people. And
really?
If the person's retiring because they had a health issue. Let's say I had a big claim in June of that year.
Right.
And I've already hit my deductible and out of pocket for my current group plan.
Okay.
Well, then they're better off on COBRA till the end of the year because their deductible doesn't start over.
I see. Okay. So when you go on COBRA, you're continuing that coverage.
That's right.
So any of those things you've met throughout the year. Okay, that's a really good point.
So you have that as an option, and then normally our initial conversation with somebody is COBRA's option one. My second question is, are you married? If you're married, you have 30 days to go on your spouse's group, if that's available. And then we get to the Affordable Care Act. So those are sort of the three legs on that stool is COBRA, spouse's group if it's available, and then over to an individual plan. And usually we'll, and it, 10-minute conversation, we'll know where they need to be. Just unfortunately, you have to ask about the income piece because that factors into the third leg on that stool.
If your spouse's coverage is available, are you required to go on? Does that eliminate you from doing the Affordable Care Plans?
It does not. Then it goes back to the affordability percentage. Now, does it cost you more than about 10% of the household
of the
income.
household income.
And
Okay.
whereas the employee is 10% of your income, if you can, but now it's a
Yeah.
household. So if it costs
Okay.
you $1,500 a month to stay on your spouse or whatever, and let's say you have a couple kids on there too, and y'all aren't making $15,000 a month,
Right.
then the spouse and kids can now get a subsidy.
Okay. Okay.
And so depending on household income, again, you still have those different steps, as I like to call them, 62,000, 84 and on up, that if they're above that, they're not going to get a subsidy.
Yeah.
But if they're below that threshold, the spouse and kids may get a subsidy.
Okay.
In that example, or the spouse.
Would you say most people do, and you may not know the answer to this, but this may just be your experience, or if you know data, feel free to share, but most people go on the affordable care plans,
I would
assuming
say
you're not Medicare
majority
eligible.
do go on the Affordable Care Act
That's where the
plans.
majority of people end up.
If they're, certainly the spouse's coverage, if it's available, is a pretty good percentage.
Yeah.
But I would say if we talk to 100 people, I'd say 60 or 70 of them go on the Affordable Care Act.
Okay.
There's
Okay.
always going to be a few that can go on their spouse's group. And if that's
Yeah.
available, generally that's the better deal
Right.
if they have decent income.
Yeah. Yeah.
But that's one of those things you just have to ask the question. I mean, that's
Yeah.
one of my early questions is, are you eligible?
How do people, because not everybody has an agent, right? I mean, because healthcare.gov, I could go on there myself
That's correct.
and try to figure this out, right? So that's an option.
That's correct. And it doesn't change the price if an agent is involved. A lot of people
Yeah.
think, I'm going to have to pay for this person's advice. I'm like, no. And again, if I talk to 10 people, 3 or 4 of them, we're going to help them, but
Yeah.
we're going to tell them, you need to go do this or that.
Yeah.
And we'll end up placing some of those 10 people in a policy.
Sure, yeah.
And that's where we get paid, from the carrier.
From the
whoever
carrier,
that carrier
yeah,
is on healthcare.gov or outside there. But, for our standpoint, it doesn't affect the premium at all. So
Yeah.
usually and I can have a quick conversation with somebody and say, look, here's what's out there. Usually the initial conversation is not someone coming in, it's just a phone call. And
Yeah.
we go through everything, and 5 or 10 minutes later, they have a better feel for where they are.
Right.
And then sometimes they call us back, and we end up helping them with
Well,
something.
I just think, to me, these things, and I appreciate your input on this, Adam, but to me, these things are so complicated. Like, it would be worthwhile to have somebody to help you navigate these. Because if this is not your specialty, I'd imagine some of these terms may sound like Greek to a lot of people.
It is that's my takeaway from this is what we're talking about is super enlightening, but there's no way that I can make heads or tails of what to do in certain situations.
Right.
And having someone like Paul here to explain it, not just on this podcast, but one-on-one when your own situation.
Right.
I mean, I think that's what a lot of people need, because it is just so complicated, and the guardrails change every year.
I know.
And it's just it's impossible to keep up with it.
That had to be real challenging when the government was shut down for you all. Is that fair? Because I've got a lady who, unfortunately, her husband died early of cancer, and so she's not eligible for Medicare yet, and she wasn't working outside the home. So she and her one daughter were on an affordable care plan. And she was talking to her health insurance contact, and we were planning her income for next year. And costs range from $600 to literally $2,700 a month was the possibility that what she might be paying, which is really hard to plan for, honestly. Like I don't know if
the
you want
biggest
to
factor
talk
there is,
about
I'm
that,
sure,
but-
their income. I mean, because again,
Oh, sure,
income's
yeah.
part of it.
Sure.
Network of providers is another.
Yeah, right.
So when we talk to somebody, there's going to be a range in there. It's going to be like you're going to be, like you said, 600 to 2,700 is not uncommon for a household of 2.
Okay.
But it just depends on. A lot of people say, "Well, I'm not sure what my income's going to be." Well, then I'm not. I can't. I need a ballpark.
Yeah, that might be important. I think that's where it's helpful if you're assuming you have investment related income, right? Or I guess if you have an advisor, I think it's great to work directly with, to
Yes.
connect those two people, because I know if I say, well, you should talk to Paul, if it's okay with you, we'll be glad to talk about anything that, that might be relevant here, because, if I'm creating these, say this person retires at 62, I'm creating their income a lot of times, right? Like, so because they're not working anymore in that case. So how I do that and how much and what years we take more, directly impacts their premiums. And
Yeah,
it sounds
'cause-
like their coverage. So, I mean, I guess to what I heard was there's kind of a double whammy in that if you can control that income, and I think doing things like contributing to your 401k, contributing to your HSA, like those are great, great tools to think about. And that's where you want to talk to your advisor too. Because if you can control that income, you get lower premiums and better coverage is kind of what
Correct.
I heard you say, which seems, I don't know, really shocking to me.
You have to adjust.
Seems
it.
counterintuitive.
It does, yeah. In a
Well-
world where usually you get more if you pay more.
Well, I'll use a practical example in Watauga County. I had a customer in Watauga recently that his renewal came up, and I just told you, it's a husband and wife,
Yeah.
roughly early 60s, and I just said, all right, I need to know your income for next year. And
Right.
The person was like, well, I'm not sure where we're going to be, and I said, well, if you're below 84,000, you're fine. If you're above 85,000, wherever that cutoff is, I said, you're going to get the hammer. And he goes, well, what's the hammer? And I said, $2,700 a month is the difference.
Yeah, okay.
To your point with the
Okay.
lady that was 600,
Right.
2,700, if he's below 84,000, then the government's going to give him $2,700 a month
Wow,
to help pay
wow.
his premiums. If he goes $1,000 over that, the government takes it back.
All of
Either on
it.
the
So
front
it's
end or
not
the back.
prorated at all.
And that was the difference in this law that's expiring. It was prorated.
Okay.
If you went over a little bit, it wasn't that bad because it was a slide. It sloped off a little
right.
bit. Now you're falling off a
Wow.
cliff.
Now you're negotiating with your employer for a pay
lower,
decrease.
yeah.
Can I get a $5,000 pay
Right.
decrease? It's just
So I can afford health
And if you're
insurance.
self-employed, you're going to go out and buy that $5,000 ice machine.
That's right.
At the office.
That's right. Yeah.
That's right.
It's a Section
Yeah, if you're
179
self-employed,
deduction,
there's
and now
probably
you get
some
the deduction.
opportunities there.
Oh, my
Like I think
goodness.
that's a really good point. Working with probably your tax advisor and your investment advisor too to help control that. I mean, I think because that's tough because I think to me it's the folks that maybe just be barely over that. And let's be real, $85,000 with the inflation we've experienced in the last few years is not huge income. That's pretty normal, if even maybe below normal.
Correct.
In my opinion, just from what you see, just because of the way costs have gone up. So that would be, to me, the roughest is if you're at $86,000 a year, because it makes it pretty
that's a tough spot.
unaffordable.
That's a tough spot, yeah.
Because you don't have a lot of leeway and you're barely over.
Yep.
Yeah, the only other thing that we haven't touched on that we've done a lot in the last month on because of all the changes at the federal level is if one of the spouses is still working and is self-employed.
Okay.
The way the law is, it's strange. I can think of a couple I talked to today, and they're going to probably save $700 a month by coming off of an individual plan and going to a group plan. Still the same insurance company.
Okay.
The only difference is they file rates differently. If they're on individual, the rate's going to be what it is. If there's no subsidy, it's high. That same exact plan, but on the group side of it.
Interesting.
If it's set up as an S Corp or if it's taxed as an S or C corporation, it's going to save them $700 a month.
Wow.
So that was an easy
It's good to
decision on
know.
their part.
Yeah.
They went, okay, yeah, we'll just move it over there.
Yeah.
But that's
that
a weird,
again,
it's
I
a blurred
think you
area because
need-
it's people that are still working that aren't retired.
Right.
But somebody does some consulting or somebody does something
Right.
where they have a small S Corp
Right.
that they're set up on. So
I think that's just speaks to what you said earlier, Adam, which is like get some advice.
Yeah.
I mean, I think it's, to me, this just seems to get more complex over time, particularly if your goal is to retire before Medicare. I think it's maybe even more critical to get some advice there because, I think, too, people just have to expect medical costs to go up over time, too. I know when I'm doing, planning with someone, we'll build in some medical costs that will generally grow at a rate probably about twice your normal inflation just because of how those costs have gone up. And that's with coverage.
Right.
So I think that certainly would be one thing I would share with people is to know that there is help out there, but you do have to take a little proactive stance, I think, on your part. Nothing's going to happen automatically, I think also be wise, I guess, too. Like I hear a lot of these like discount things, and I'm never quite sure about those, discount coverage, and kind of you've talked about that a little bit, but it just feels like there's maybe some things out there that because this is so complicated, people cannot understand.
and until somebody has a large claim, they don't really. I mean, if it's a discount program, again, that person thinks, I'm only going to have less than $10,000 worth of claims. I'm going to get a discount on it. I said, what if you have a $50,000 claim or a $100,000 claim?
What if you need a new heart?
And exactly. Right. And the hospitals are real good about, if it's a needs-based situation, they'll work with you.
They'll work with you.
So that's a good thing. I know of a nonprofit in town that we help with that, if that happens, there's some negotiation there. But again, they may want your tax returns. They may want some other things.
Okay, that's interesting.
To prove some things. Yeah. And then, but again, the hardest part is, what's that exposure going to be?
That's right.
Depending on what you have going on. And the nice thing on a predictable part from your side of it is, during Medicare, it's a little easier to predict.
Oh, it is for me.
Once somebody's on Medicare, it's the exposure's not that bad.
That's right.
It's leading up to Medicare's is the harder part.
Yeah, and I think speaking to retirement planning, I mean, a lot of times, I may be working on a case and say, well, yeah, you could retire at 60 or 62. But unfortunately, a lot of your income is going to have to go for health insurance. And, do you want to do that, or are you happier to continue to work and have maybe a little bit more discretionary income? So it's an important piece of the pie, and I think that's why, just appreciate, having someone that I can turn to rather than just an average cost, because average is by definition average. It's not going to be
Doesn't apply to.
Yeah. Most people, it's not going to be exactly that. So it's a really important, not fun for the holidays.
No, it's not. But we're here just to provide some realistic perspective on certain things and remind people of what they should be looking into this time of year when they're focused on a lot of other things that they're getting from where they absorb their content. So, Paul, why don't you let's go ahead and tell people where they can find you, because there might be people out there that could use some guidance here.
That's right. Maybe their New Year resolution, right?
Luckily, I'm about a half a mile away from Jennifer's office up on Maplewood Avenue near Forsyth Hospital. Our phone number, 336-765-4980 is the office number. We have an office in Kernersville as well, but we probably have about 5 or 6 representatives that work with us. So happy to hear from anybody.
And we'll put his information in the show notes as well. And then, Jennifer, if you want to remind people where they can find you in your office.
Yeah, we're all here in Winston. We're all together actually right now, which has been fun. But
it's the weirdest holiday party ever.
I know. Yeah, we're located here off Stratford Road, and you can check us out online. We're at 3 Magnolias financialadvisors.com. Give us a call to 336-701-1600. We're local too, so check us out online or give us a ring. Hopefully people can take this and, as they look into 2026, just make some informed decisions and protect themselves.
Yeah, and hope everyone that their holidays do not include filing any large health insurance
That's
claims.
Right. Absolutely. Everybody be safe. No dangerous activities.
That's right.
Keep the drinking under control.
And those new toys, make sure you wear your helmets, all those.
That's right.
All those
Nothing.
fun things.
Stay away from the wishbone, all the stuff that could injure you.
That's right.
Before you get the coverage, especially.
That's right. All right. Paul, Jennifer, thank you both so much.
Yeah, thank you.
Securities offered through Private Client Services, member FINRA SIPC. Investment advisory services offered through 3 Magnolias Financial Advisors, located at 110 Oakwood Drive, Suite 480, Winston-Salem, North Carolina, 27103. 3 Magnolias Financial Advisors and Private Client Services are not affiliated. Private Client Services is under separate ownership from any other named entity. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. The market indices discussed are unmanaged. Additional risks are associated with international investing, such as currency fluctuations, political and economic stability, and differences in accounting standards. The views depicted in this material are for information purposes only, and not necessarily those of Private Client Services. They should not be considered specific advice or recommendations for any individual. Neither Private Client Services nor any of its representatives may give legal or tax advice.
This is the Triad Podcast Network.